Welcome, everyone. My name is Nikki Johnston, and I'm with Transition Advisors. Our webinar today is Planning for Succession. What are your options? Before we begin, we need to cover just a few important items. First, please close any other programs that you have running on your computer. This will just help to ensure a quality presentation and reduce any audio issues. Transition Advisors LLC is a proud and approved sponsor on the National Registry of CPA Sponsors per NASBA. Under NASBA guidelines, today's 60-minute session will qualify for 1.2 CPE credits. In order to receive those credits, you have to meet two requirements. The first is that you participate in all 4 polling questions throughout the presentation. If you participate in at least 3 of the 4 polls, you'll get partial credit of 1 CPE. Please note that GoToWebinar does monitor your participation in the polls. Next, you'll also need to complete an online evaluation. This will appear on your screen immediately after the session ends. So please take a moment to complete that before you close your browser. Once you've met both of those requirements, I will email you your CPE certificate within 10 business days. Now, in order to fully participate in the webinar, please take a moment to familiarize yourself with the GoToWebinar control panel. You should see it on the right-hand side of your screen. There's an orange arrow near the top. You can use that to minimize the control panel if you wish. During the presentation, all participants are muted, but you can communicate with us by using the question box. You'll see that toward the bottom of the panel. Just type your question there and click send. As you can see, Terry is also using his webcam during today's presentation, and you're welcome to resize that, minimize it, or even close it if you wish. You'll be able to view that in addition to the slides, as you can see right now. Finally, I'd like to remind you that Transition Advisors offers CPE webinars each month. Our upcoming topics that Transition Advisors is hosting includes non-traditional mergers, whether that's a short-term trend or here to stay. That's on July 10th, presented by Bill Carlino. On August 21st, Terry will present case studies on admitting new partners. And then Joel Sinkin, our president, will be presenting with CPA leadership several sessions in July and in September. You can view all of our CPE and register. All the links to register to them are on our website. Just go to the CPE courses section of transitionadvisors.com. Now, as a quick reminder, you did receive in your reminder email a link to download the slides. I'm going to go ahead and send that to you now via the chat box. So you should be able to open the slides there if you'd like to follow along. You can also email me if you have trouble with that link or would prefer that I send you that as an attachment. Now I'd like to introduce you to our presenter for today's session. Terry Putney is the CEO of Transition Advisors. Thanks so much and enjoy today's webinar.
Hello, everybody. Before we get started, I'd just like to introduce you to our firm, Transition Advisors, for those of you that aren't familiar with us. We work exclusively with accounting firms on a national basis, and we work only in the area of issues affecting the ownership of an accounting firm. So that involves a lot of the work we do. It involves mergers and acquisitions. We both introduce parties to a deal as well as help support negotiations and support, in fact, the process all the way through to closing. And we do a lot of work in the area of owner agreements, which is an area I happen to personally be involved with extensively. So that we not only help firms fix an owner agreement that maybe isn't working as well as it should, but we also help develop new agreements for firms that don't have one. To get started here, just to give us an idea of who our audience is, we're going to start with a polling question. I'll turn it back over to Nikki for that, please.
Okay, thanks, Terry. How many equity partners do you have in your firm? Is our first polling question. You can see the options there. Are you a sole proprietor, 2 to 4 partners, 5 to 9, 10 to 19, or 20 plus? Give everyone just a few more seconds. We've got nearly everyone having answered. Just keep in mind you do have to do all 4 polls for the 1.2 CPE, and at least 3 out of the 4 to get a credit. Okay, there we go. Now we've got everybody. Thank you. I'll go ahead and close the poll. So Terry, 57% of the folks on the call today are sole proprietors, and then the other 43% are in the 2 to 4 equity partner range.
Okay. For some reason, my webcam came up on my view. You think I can close that out?
Well, we can see you on the webcam, and it's
No.
showing your slides again, so I think we're good.
Can you still see me?
I can. Yep.
Okay, very good. All right, so let's ask ourselves for a moment, why are you here? What interested you about this topic? My experience is that it's likely to be one of four things, and it could be actually more than one of those things. For instance, you might be wondering, for those of you that have an idea that succession is near for you or some of your partners, is your bench strong enough to take over the firm and buy out partners that are going to be retiring? If you have an owner agreement already, is it going to be affordable? Will it actually work to buy out partners and pay them fairly for their interest in the firm, as well as allow the other partners to make those payments? Or if you're a sole proprietor and you don't have an agreement, but you're expecting to admit new partners, maybe you're thinking, what should that owner agreement look like? And then how do you admit new partners, for those of you that feel like that's a necessary part of your succession planning? And finally, something that all of us probably think about kind of regularly is, what is my firm worth? And especially if I'm thinking, okay, the internal succession may not work and I have to go out to the open market and sell my firm, what can I expect to get for it? I'll warn you a little bit. I modified the slides slightly in a few cases, took out a few so that I can get through this presentation. I think I had too much content. So the link that Nikki sent you, the deck's going to be slightly different from this one. And if you feel like you want the more updated one, feel free to let us know that. Throughout the presentation, I'm going to be referring and using as an example a recent project that I was involved with actually in the last couple of weeks. This was a 5-partner firm, about 7 million in volume. 3.5 million of that was controlled by or managed by the managing partner, who wanted to start retiring in the next 12 months. And so the concern was, is the owner agreement going to work? Is it affordable? Do we have the bench necessary to take over for this partner? How's this whole plan going to work? This firm had actually kicked the tires a little bit in the open market, talking to other firms, and just couldn't get comfortable that that's what they wanted to do. So they asked me to come in to help do an assessment of their situation. So I'm going to refer to that example several times throughout this presentation because it's so top of mind for myself, and I think it provides a good example. This webinar is going to be a broad assessment of all 4 of the issues that I just went over with you. I think you'll find that it's kind of a top level type analysis. Several of the topics that I'll just touch on are topics that we get into much more in depth in previous webinars that we've done. And you can go to our website and actually view and download those webinars. And I'll refer to which ones specifically I think are relevant throughout the webinar. You won't be able to get CPE in those cases, but I think you'll find the content to be very helpful. So first, let's ask ourselves, how strong is the bench, and what is your succession need going to be? I think the first question to ask yourself is, which partners do we need to replace, and what's the timing of that replacement? And then as you go through that, ask yourself, for the partners that you feel like you need to replace, is this something that is their role something we can redistribute throughout the partner group as it currently sits? Or is this something where we're going to have to admit new partners? We're talking about, in that case, both capacity, meaning do we have enough people to actually do the work, as well as skill set. So in some cases, we might have the capacity. There might be partners we've admitted in recent years that have some capacity to take on more work, but they just don't have a special skill set that a retiring partner might possess that we need to find a replacement for. So this is a tool that I use oftentimes to start off a retreat that I might conduct for a firm. And we go through this analysis for each of the partners in the firm. So, who's going to retire and when, and how do we need to replace them? So in the case of partner A in this example, who's a partner that might retire in the next 1 to 3 years, the feeling is that their skill set, the amount of business that they're managing, their role in the firm, is something that we can absorb throughout the rest of the partner group without bringing a new partner in. So that doesn't create an immediate need for an admission of a new partner. However, in this example, within the next 4 to 7 years, partners B and C are going to retire, and we're going to need to replace them with people that we don't currently have in the partner group. And then to carry out the example to its conclusion, within more than 8 years, partners D and E would both represent a reallocation, meaning no need for an additional partner, as well as a role succession, which is a need for an additional partner. So this tells you what you need and when. In the example that I mentioned, that of the firm I worked with here recently, we had a partner, the managing partner, managing roughly 50% of the firm's business. And it was clear they didn't have the capacity within the existing partner group to take that over. And so we were looking at, do we have the capability within the firm to admit new partners as we're going to need them? And it's going to be at least 2 in this case that we're going to have to admit. I'll be honest with you, I don't think this firm is probably destined to be able to pull this off, but we're doing the best we can to pull together a plan. And in that case, we had, role succession, and actually double role succession for this particular managing partner. So when you look at when the conclusion leads you to the idea that yes, we do need to admit new partners, this is when we need them, you really need to think about a 2+2 type plan. What I mean by that is that when does that partner need to be in place in order to be capable to actually provide succession for the role that a retiring partner is going to leave behind. So generally, our belief is that a new partner probably needs at least 2 years to kind of get acquainted with what it takes, what it means to be a partner. The idea that a brand new partner can step into the role that a partner that might have been with, that has 40 years experience in the profession or even more, left behind, is maybe a little bit naive. And then there's a 2-year transition plan that really needs to be conducted for that partner's role. We'll get into more of that later in this webinar. But in essence, what we're saying is that when you look ahead and say, partner A is going to leave in 4 years, we need to replace this partner, we've got to have the people in place that are going to replace the partner probably 4 years in advance of that, if not sooner. So you've really got to be realistic about what the timing is for succeeding partners. One of the tools that I use in doing this, because what I'll find is I'll sit around the room, and we did this with this recent example, 5 partners all sitting around the table, and we're talking about the candidates of the people that weren't at the table that needed to be in the next, very near future. And as I asked them, are they ready? It was difficult for them to reach a consensus as to who was ready and who wasn't and why they weren't ready. And so we walked through basically what you could call just a job description for a partner in a typical CPA firm. And we walked through this evaluation for each of the people that were a candidate to be promoted. And what this in essence says is, and this is something that should be unique to your firm, you can use this as an example to start with. What are the things that make a partner in your firm successful? What do they have? What attributes do they have to have in order to be, really a successful partner in your firm? So I'm not going to read through all of these, of course, and there's 2 pages of them, but it helps for you to go through on a case-by-case basis and ask yourself, Sally, if Sally's one of the candidates, what does Sally do well on this list? What is skills she already has? What is she missing? And if she's missing something, how are we going to fill in that gap, and how critical is that to her role? So, obviously what you're trying to identify there are gaps in her current performance, and you're trying to, address how do we fill in those gaps. One of the techniques that we're seeing firms use increasingly now is the use of non-equity partners. Some surveys would indicate that as many as 50% of larger firms now have non-equity partner roles, and I've seen firms that have more non-equity partners than equity partners. I think that's maybe overdoing it, and I have a concern about what that means long-term for some of those firms. But in the Rosenberg survey, which, by the way, I highly recommend if you're not participating in, you consider doing, the Rosenberg survey, 77% of all the firms in excess of 10 million, which would probably be greater than most of the people on this call, are using this tactic, and 50% of the firms that are in the $2 to $10 million range are using it. So you got to ask yourself, what is the purpose of a non-equity partner status? Typically, when we're talking about succession, we're usually talking about a path to equity. So what we're talking about is let's put this person in a position of being a partner as far as the outside world and inside world is concerned, give them all the duties and responsibilities of a partner, but not actually ask them to make the investment and us make the commitment to them, the final commitment for them to become an equity partner. And usually if you're going to do it that way or use that tactic, you want to limit the amount of time they're going to be in that role to probably no more than 1 to 2 years, maybe 3 at most. The other reason to have a non-equity partner, in this case for succession, is if you're going to put someone in a permanent status as a non-equity partner, what you're basically saying is, we don't think this person is going to be able to overcome all of the gaps that they have in their performance. But we don't want to lose them. They're a key person in the firm. They may be controlling a significant book of business, maybe a $300,000 or $400,000 book of business. We don't want to lose them. We don't want to take the risk of what might happen if they leave. Let's put them in a permanent status as a non-equity partner. It's really just a matter of holding on to whatever value it is that they're creating at this point. You just need to make sure that they don't get in the way of other people that need to be promoted. These are 4 outside. We have no formal relationship with any of these groups. I happen to be on several peer groups with key people in each of these organizations. And I have some experience with each of them, and I believe that all 4 offer very good partner development programs. But if you're looking for outside training for how to get a partner, either someone you've recently promoted a partner and you're trying to get them, make them stronger, or you're trying to get somebody to fill in the gaps so that they can become a partner, I suggest you look into one of these 4 programs that are made available by these excellent consulting firms. All right, so let's get into assessing your owner agreement, and that will take us to the next polling question. Nikki?
Yes, the polling question is on your screen already. It says, does your firm have an owner agreement? And your choices here are yes, and it's signed by all owners. Yes, but not all owners have signed it. No, and you know that you need one. No, you're not sure that you need one. I'll give you about 10 more seconds. Those of you who haven't voted yet, please go ahead and do so. And again, it looks like some of you may have missed the first polling question. As long as you complete 3, this one and then the next 2, you'll still be able to receive 1 CPE credit. All right, that's nearly everyone. I'll go ahead and close the poll now. And the results are there. So 64% say no, and they aren't sure that they need one. 24% yes, and it is signed by all owners. And then 8% know that they need one because they don't have one, and 4% have one, but not all owners have signed it.
Okay. Not unusual answers under the circumstances. One thing I'd point out is that if you have partners, if you're in a 2-owner or more firm, without an owner agreement, you're really at risk for someone other than the 2 of you deciding what happens to ownership in your firm. So for instance, in a divorce, in a death, the 2 of you don't get along anymore and all of a sudden you're fighting out how to break up. Those are all things that you can determine. It's like a prenuptial agreement or a will or a trust. I mean, it's a necessary part of having a multi-owner firm. If you're a sole proprietor and you're thinking about internal succession, unless you're going to, just sell the firm directly to an employee and exit the scene as an owner, there's going to be a point in time when you're going to be partners for a while, and an owner agreement is a key part of creating that and executing that plan. This is an area where we're only going to be able to sort of brush over and at a high level some of the concepts. One of the webinars that we presented last year that you can access on our website is called Partnership and Shareholder Agreements 101, and I'd recommend, if you want to get into more detail about what I'm going to talk about here, that you download and watch that webinar. So there's 2 concepts here that we really need to deal with when it comes to owner agreements. First is understanding what really creates value in your firm, and second is understanding what financial terms are appropriate for your owner agreement. I do a lot of consulting on owner agreements. As I told you, I did roughly 25 projects last year where I either wrote or fixed wrote a new one or fixed an owner agreement. When I say wrote, I mean I'm not an attorney, but developed the terms for and helped negotiate between the partners. Almost all the projects that I get involved with start off with the parties being concerned about the financial terms. The feeling is we really may not be able to afford the buyouts, and that very well may be the case. I see a lot of owner agreements that have horrible terms that in fact aren't affordable. But as we get into the project, almost always what really is behind this issue is the ability to replace and properly transition the role of retiring partners. And there's an uncertainty that the younger people or the people that aren't even owners yet are going to be able to do this. And so, so why am I bringing that up now? We just went through that again. I think the important part of this is that we're going to get into in a minute is to understand that the business plan that you have in mind for replacing retiring partners actually ought to be embedded to a certain extent within the owner agreement. And you'll understand that more in just a minute. So what creates value in your firm? I mean, most of us think that all of these things are important. So if we have, for instance, high performance metrics, our people are very billable, or I've got high billing rates, or I have a high realization rate. Maybe my location, because I have a really top-notch location in my market and it's got a really favorable lease. I'm well known in my market. My brand name is important. The services I offer are of a high quality and maybe in some cases unique. I've got really strong staff. My clients are really strong and maybe I'm very profitable. All of those things, of course, do in fact contribute to the value of your firm. And in an external deal, some of those things probably come into effect more so than they do in an internal transaction. But to understand the value in an internal transaction, you need to understand that the most important driver of value is partner roles and performance, and particularly in the size firms that are on this webinar. So the keys to maintaining that value are, just think about it. If you only have two partners in your firm and one of you got hit by a bus, it's likely that the firm's value would immediately overnight decline. And if not, if you weren't able to replace that person immediately, it might decline permanently. So understanding that the partner role and performance is what really drives the value in most firms, and that what we need to do in order to maintain that value is to have a proper transition of the role, enough time to execute the transition, and of course the right people to transition it to, which is what we talked about just in the last section. So the key here is tying the transition in your owner agreement, or tying the transition to your owner agreement. It's pretty common now in the profession that a 2-year notice period is required for full value. So now what we're typically talking about in most agreements are based on the concept of if we're going to have an internal transfer of ownership, the value is going to be fixed at the date of retirement for the owner. It's not always the case. In some cases, we can't get comfortable that we'll ever be able to do that. But if we can do that, if we can create a plan where the owners that are going to be leaving will in fact know what they're going to get when they leave, we have a much greater chance of success for a transition of ownership than if we're in a situation where nobody knows what they're going to get paid and the deal's contingent. So most agreements would anticipate that that's what you're going to do. But in order to do that, obviously the firm and the remaining partners need to feel comfortable that they're going to retain the business that a partner who's left was responsible for. So what we generally recommend is that there's two parts to this requirement. One is that you give adequate notice that you're going to be leaving, and 2 years is what we typically see. Most lawyers would tell you 90 days. I've seen agreements with no notice required. I've certainly seen a lot of agreements with less than 2 years. But if you really understand how an accounting firm works and you understand how the relationships in an accounting firm work, 2 years gives you enough time to transition the clients from their loyalty to one partner to a new partner. The other thing that I was asked for years and years was, okay, we got our 2-year notice, but how do I know that's going to work? What if they don't actually transition? So what we've been seeing recently a lot more of is a requirement also that a written transition plan be created at the beginning of the 2 years, and that the plan be executed to the satisfaction of the firm in order for the obligation to the retiring partner to be fixed at the date of retirement. So a failure to provide adequate notice or a failure to execute the plan would require some kind of consequences. And generally those come in the form of either a fixed discount from full value, or actually in cases where it makes sense, what I prefer is to actually look at a contingent type deal to say, okay, how much business did we lose because of the failure to comply with either one of those requirements? The second piece, when we look at the financial obligations that are required, is the deal affordable? And for it to be affordable, we really need to meet the requirement of, we don't want the remaining partners to take a cut and pay, nor do we want them to have to borrow money in order to buy out a retiring partner. Neither of those tends to be motivating for partners to execute a buyout. And so in order for us to assess affordability, you need to start with the concept that a partner's foregone compensation, what they used to make, and I'll go through an example of this in a minute here, is the capital that we have available to do 3 things with. We need to pay off the retiring partner. That's the financial terms of the deal. We need to replace that partner, and there's a cost associated with that. And there needs to be some upside for the remaining partners for assuming the obligation, or else they're going to feel like they're just running in place for the next, say, 10 years while we pay them off, and there's no upside. What's the benefit of doing that? I may not even be here in 10 years. And so there's the analysis that we need to go through with that is what we're going to talk about in a second. Going back to the example of the firm that I was working with in the last 2 weeks, a situation I came into was that the firm had a valuation of 1.2 times volume, and all the payments were for acquisition of a retired partner's stock, which meant it was totally non-deductible, and it had interest on top of that. My analysis was, of course, that when we look at affordability, we're looking at cash flow. And if you have a non-deductible plan where we're buying stock from you, then you have to earn $1.50 to have $1 left over after tax in order to make the payment. So effectively a 1 times multiple would actually be a 1.5 times multiple. And of course, in this case, a 1.2 would actually be a 1.8. And then the interest on top of that added another 20%. So in effect, what they had was a plan that really was valued on an apples to apples basis with other firms at about 2 times volume. Needless to say, it was not affordable. So in negotiating with the partners, and I only had a day to actually do this so far, as far as they were willing to go was to get it down to 1x, which even in their own evaluation would have been only break even for a 10-year period. So it was kind of still pretty far off the mark, but made a little bit of progress. So here's an example. Say we've got a firm with this doing 3.9 million in volume. We have an owner that owns 35%. That owner's capital, which would be the accrual basis capital, this is the receivables and WIP and also whatever other assets we've got on the balance sheet. His share of that was 350,000, which is roughly about what a well-run firm would be on a $3.9 million volume. That retiring partner's comp and benefits, say, is $425,000. And when we look at replacement cost, we have to at least replace the personal production that this partner is responsible for. So in this case, this partner's billable time is about $400,000 per year. The replacement resources, I don't care who you hire, is going to cost you about 40% of that at least. I'm not going to suggest that we need to replace a retiring partner making $425 with another partner making $425. We couldn't afford to do that. But we have to at least recognize probably $160,000 of replacement costs. So if you take the 160,000 from the 425, that leaves you 265,000 of capital necessary to accomplish the buyout and leave some upside behind. So it wouldn't be unusual in many cases, firms that I've worked with and I've come into what their existing agreement is, because they oftentimes have tried to replicate what they perceive the outside market to be, would be to pay the capital at the end of the first year. That's 350,000, and to make the retirement payments based on a 1x multiple over 5 years. And so the 5-year payout would be about $273,000 per year. What does that look like? Remember, we had 265,000 of available capital after the replacement cost. We had 273,000 of retirement payments. The 350,000 of capital plus the retirement payments created a negative cash flow in the first year of almost $360,000. Now you're going to say to yourself, and oftentimes sellers think this way, even if you're selling to your other partners, well, that capital is my money. Well, of course it's your money. That's why we're going to pay it to you, but it doesn't change the fact that it's cash flow that the firm is going to have to replace somehow. Potentially, new partners will put in new capital, and that'll make up some, if not all of it. But when looking at the affordability of this plan, I think we have to take it into account as negative cash flow. So that's during the first year, and then years 2 through 5, we're still at an $8,000 negative cash flow, and of course we have nothing left over for the remaining partners. So an alternative to that, one way to fix this, would be to pay the capital over 5 years, pay the retirement over 10 years. It's a simple fix. Let's see what that looks like. Remember, again, we're at 265 of available capital. Now the retirement payments are half what they were, so they're 136.5 each year. And we pay the capital account over 5 years now at 70,000 per year. So we've got a $59,000 positive cash flow in the first 5 years. And then we have years 6 through 10, even higher, 128,500 of positive cash flow. I still think this is a little skinny, even though it's positive. I still think it's probably not as it's a little bit rich still. And this is one of the reasons why I think you're seeing a reduction in valuation multiples on internal deals. You're also seeing them in external deals, by the way. And if you were, for instance, to use an 80% multiple instead of 1x, you'd roughly, over the 10-year period, average about $156,000 of positive cash flow, which is roughly 50% of the available capital. So, that's generally what I shoot for, is about 50% of available capital. So what are we seeing in terms of internal valuations? Well, again, based on the 2017 Rosenberg survey, firms that are 20 million and higher, which are generally going to have anywhere from 10 to 20 partners probably, the average multiple of their goodwill or the intangible value, this is without capital, would be, regardless of the method used to determine it, by the way, would be around 77%. The smaller the firm, the higher the multiple tends to be. But even the firms that are under 2 million, the average now is around 89%. So again, you're not going to, I never say to someone, you should be at X percent because all of your peer group is at X percent. It's really the more important evaluation is internal. This is a guide just to give you an understanding of kind of, how do you fit in with what else is going on in the profession. I'll tell you that in the PCPS surveys that are done every 4 years, less than 5% of the firms that respond to that survey, and they tend to be a little smaller firms on average than the Rosenberg survey respondents, less than 5% are using a multiple of over 1x. So if your agreement has an over 1x multiple, you're pretty much an outlier at this point. Let's see, there we go. So let's talk about admitting new partners, and I'll turn it back to Nikki for just a minute.
Okay, thanks, Terry. The next polling question is, what issues do you see affecting your practice most in the next year? Your options this time are succession for retiring partners, admitting new partners, client retention for the retiring partners, or need for growth? This is our third of 4 polling questions, and I'll leave it open for about 10 more seconds. Okay, that's nearly everyone. I'll go ahead and close the poll. 48% indicate need for growth, 28% say succession for retiring partners, and then the other 2 options have an even split at 12% each.
Okay. So, the typical approach and what I normally see in firms the size of most of the firms on this webinar is the use of the equity method for determining value and allocating value. So in the equity method, somehow we decide that I own, whatever I own, 20%, you own 25%, Joe owns whatever, 15%, and so forth. And at some point in time, that made sense. Oftentimes, we may have formed, especially in 2-partner firms, we may have formed the firm with existing books of business that we developed elsewhere. I came in with $600,000 book of business, and you came in with a $400,000 book of business. So I'm 60% and you're 40%, and it never really changed. And maybe over time, because you did a better job with practice development, you've now got a book of business that's the same as mine or even higher, and we might have somehow negotiated a difference in that split. But that's typically how the equity method works, and unfortunately, most of the time, over time, those percentages tend to get skewed and not make sense anymore. But if we don't actually start buying someone out or using the equity percentage for something like determining compensation, which most firms don't do and rightly so, usually the equity percentage doesn't come into play until people start getting paid. And now all of a sudden we've got a problem, because my 60% that we decided 20 years ago made sense doesn't make sense anymore. That's when I get called in oftentimes. But, again, keeping this concept, I kind of got ahead of myself a little bit, but keeping this concept in mind, it's typical that we would value the firm as a whole. Let's just say we decide we're going to use 1x multiple, or 1x of revenues as the multiple. We select a portion to sell to a new partner, and we allow that new partner to pay that over time, oftentimes with compensation adjustments, although I would say there's a fair amount of situations I've seen where the new partner was expected to go to the bank and borrow money. So needless to say that this can be very expensive for the new partner, and oftentimes the amount of equity that we're willing to sell them is based on what we feel like is affordable. So it's not unusual for a new partner to come in at 10% or even less than 5% of ownership, just because the number is manageable at that level. The common objective usually in creating a new partner buy-in that I hear is we want to create skin in the game. We want them to have an investment. We feel like they'll perform better. We feel like they'll respect what's required to be an owner in the firm if they've actually written a check or somehow experienced a financial investment as a part of that. And I don't disagree with that, by the way. I'm not saying that's wrong. So let's use an example of what this looks like. Again, we go back to a $3 million firm. We're using 100% of multiple. We've got $500,000 of capital in the firm. The total value is $3.5 million. So a 10% interest is $350,000. And so a new partner that came in might be expected to take a $50,000 haircut in their compensation over a 7-year period. I kind of made the 7 years up in order to acquire a 10% interest in the firm. Well, the potential issues this creates, of course, is the cost of the new partner, which, if their compensation's gone up enough, maybe they don't feel like that's a bad deal. But how much are we going to increase their compensation in order for them to afford the buy-in as well as have some upside in their compensation? Needless to say, none of us would want to work for the next 7 years knowing we're not going to make any more money because all of our upside was going to the buy-in. But at the same time, how much are we willing to give up in compensation from the other partners in order to make this happen? Aren't we actually just paying for the new partner's buyout with our own money? Are we really accomplishing anything? So, and then how do we deal with acquiring more equity down the road? Now they've got 10%. When do we actually offer more, and how do we do it? Do they keep writing checks? So, this the problem with the equity system is that it has all of these issues that tend to get unresolved until it's like a rubber band that gets stretched. At some point in time, it's gotten so out of whack that we have to do something, and we end up negotiating. So an alternative approach to this, and again, there's another webinar that I'll get to. I'll suggest in a minute that you look at. There's also an article that we wrote for the Journal of Accountancy in December of 2015 that you can download from our website. It's called Admitting New Partners, a Fresh New Approach. The first thing to do is to recognize that the value in your firm is actually made up of two pools of value. One is the intangible value, and that's what we typically associate with the revenues. So if we talk about 1X, we're talking about the intangible value. The tangible value is your accrual basis balance sheet. So let's deal with those in two different pools. One of the things we can do to hold down the value that we're requiring, or the investment we're requiring from a new partner, is to sell them only the tangible portion of the balance sheet. So if we go back, if I can do this, go back to our example, we can sell them only a portion of the capital account. So we, a 10% interest, and at that point it's only $50,000 instead of $350,000. We can sell them more than 10%, or we can obviously hold down the investment. But in doing that, we want to delay the allocation of any intangible value to them until later. And we can do that through a couple of techniques. One is through vesting. It's not unusual to see vesting programs that would have as much as a 15-year, is even a 20-year tenure required before any intangible value or any significant intangible value is accrued to the benefit of a new partner. That's typically what you do in a compensation-based intangible allocation. If we're paying 3 times comp instead of using an equity method, we most likely will have a long-term vesting program. The other technique that we use that I describe in detail in both the article and this other webinar is the AAV unit method, which in that case, what we do is we assign units to the intangible value, and those units are distributed amongst the owner group. And over time, those units are reallocated, usually on an incremental basis, based on more growth. So as we grow, new units are created. We share that growth amongst the owner group. As partners are bought out and we buy their intangible value from them, the intangible value that's reacquired, almost like treasury stock, would be reallocated to the existing partners. And so no partner is expected to ever buy units. They earn units through sweat equity, but no partner is also expected to give up any units. What it basically creates is a sharing arrangement where you and I, as a team that's buying out a retiring partner, are sharing in the value that's created by that buyout. So again, I suggest you go to look at this webinar or read the article that I previously referenced. Okay, with that, I will turn it back over to Nikki for our fourth and final polling question.
Okay, this last question is, in the next 5 years, what is your firm likely to do? Sell, acquire a smaller firm, merge into a larger firm, or you're not sure or plan to do nothing different? As Terry said, this is our fourth and final question of the day. So I'll give everyone just another couple seconds. Looks like we've got nearly everybody. There we go. Everybody's voted. I'll go ahead and close the poll. So fairly even split here. 26% say sell, 22% acquire a smaller firm, 19% are likely to merge up, and then 33% are not sure or plan to do nothing.
Okay, so for those of you that are either going to sell or acquire another firm, this next section will be of high interest to you. So we're going to talk a little bit about valuation. First off, one of the questions we're getting constantly is it a buyer's or seller's market? And I will tell you that the answer is yes. It depends on the market. There's no question that there are many, many more sellers in the marketplace now than there were 10 years ago. And this is a demographic thing. There's no secret. We've all been hearing about this, and we're personally experiencing it. But most firms continue to be owned by baby boomers. Baby boomers are reaching, the age where they're going to retire. I think it's something like 10,000 or 15,000, something like that, every day. Baby boomers turn 65 years old. So there are, and statistics tell us that within the accounting profession, they're still holding on to a very vast amount of ownership in accounting firms. So that flood of sellers, of course, creates, the buyers have also increased, but not by the same extent as sellers. So the classic supply and demand curve that we all learned in economics is coming into play. And as a result, valuations are being driven down because buyers have more firms to select from, and they can be pickier about the terms. But the real issue is that your particular firm is the value of your firm. It depends on who you're talking to. One man's ceiling is another man's basement. So, your firm may not be worth very much in terms of not even worth enough to acquire for one firm, but might be highly sought after in another firm. Here's a great example. Let's say you've got a practice that's heavily dominated by 1040s, and assuming that you get decent fees for them, a lot of firms that are mostly oriented towards business clients would say, I'm really not interested in that practice, or that part of the practice I'm not interested in. Whereas a firm that has a heavy emphasis on wealth management might find that opportunity for cross-selling makes your practice very valuable for them. So it depends on who you're talking to. It also depends on where you're located. And firms that are located in larger markets are going to have access to a lot more buyers. And as a result, are probably going to be in more demand than a firm that's located in a smaller market. The size of the seller firm makes a difference. Believe it or not, firms that are smaller tend to be worth, in terms of multiples, more than firms that are larger. And a lot of that has to do with the nature of the acquisition, the nature of, if you're a sole proprietor and you're going to be leaving the firm in 3 or 4 years, the firm that's buying you is primarily buying your book of business and is looking at it from that standpoint. Whereas if you're a larger firm with, say 4 or 5 partners, it's probably more likely going to be a merger, and the valuation of the firm is going to be more based on the acquiring firm's owner agreement. And as we talked about earlier, that's probably going to have a lower valuation than in the open market. Your specialization can actually be a plus or a minus. If you're so specialized that it's hard to replace you, or it's hard to find firms that have or need that specialization, that can drive the value down. Litigation support practices tend to command smaller valuations, even though they tend to have a premium within the firm in terms of rates. And maybe you might say that even makes them more profitable. They tend to have a lower valuation in the open market. And the immediacy of succession needs. The closer you are to retirement anymore, the less valuable your firm's going to become, because you're asking a firm to take over your role immediately, as opposed to having time to kind of work into that role. So what we're finding is that for sellers that have waited to the last minute to go to the market to say, hey, somebody take this thing off my hands, I'm ready to quit, are finding fewer and fewer buyers that are willing to take that on. So I wouldn't say it's generally a buyer or seller's market for sure. It just depends on your situation. If you're going to be merging up into another firm, really to say what's my firm worth? Well, your firm's worth is going to be determined by your successor firm's owner agreement. So if you merge into a firm that pays 2.5 times comp over 10 years, and your comp is $300,000, you're going to get $75,000 per year. Kind of doesn't matter what your firm is worth, that's what you're worth in that situation. If you're merging into a firm that uses the equity method, now all of a sudden there is some relative value between your firm and their firm, but oftentimes that's only determined by the relative revenues of the two firms. And again, if they're using a 80% multiple for their deal, that's what your value is going to be based on. There are situations where if the profitability is dramatically different, there might be an adjustment made in the equity that's allocated, but oftentimes it's just a relative revenue type arrangement. So your value in a merger is really a matter of assessing the other firm's owner agreement, the other firm's partner compensation agreement, what role do they want you to play, what opportunity does it create for you, and so forth. Okay, so let's say you are selling. What's the multiple? You know, some of us have, I think there's still to this day, most people would default start at 1x, call that kind of the standard multiple. If we're offered 7.5, we might see that as a discount. 1.2 might be considered a premium, and a lot of firms in larger markets might think, well, I can get 1.2. And I heard about firms, 10 years ago, they were getting 1.5 or even higher. And that may have been the case, but certainly it's going to be more difficult to get that now. Could I get 1.75? Well, as you're going to find out here in a minute, the multiple actually can be the result of a whole basket of terms in terms of a buyout arrangement. So we can justify a very high multiple if there are certain terms, other terms that are involved, or we could justify a much lower multiple if, again, those terms go the other way. We all tend to focus primarily on this multiple, and so we can use this as a way of negotiating the other terms or vice versa. So the first thing to look at is how much cash up front. If we're an outright seller, let's say that we're going to sell, we're going to work at the firm on a part-time basis for a year or two, but we're going to start getting we're going to expect to be paid money for the practice pretty much right away. Then cash up front, a down payment might be appropriate. The deals that we see, we very rarely see any more down payments of more than 20%. We see a lot of deals done with no down payment at all. One of the things to take into account here is the investment that a buyer's making in your practice. If you had $1 million practice, chances are your capital is going to run around $250,000 to $300,000. If you're going to retain that capital, which is typical or it's becoming less typical, but it certainly used to be almost always the case, in an outright sale, the buyer has to replace that $250,000 or $300,000 of capital in the first year. I recognize there's an asset there, but from a cash flow perspective, that's cash flow they're not going to realize in the first year. On top of that, it's probably at least another 10% investment made for technology upgrades, for moving costs, for marketing costs, for lost productivity. And so it's not unusual to budget about a 35% investment by a buyer. And that's money that goes into the deal before you ever see anything other than the fact you were able to retain your capital. So to say that the buyer hasn't made any investment up front when there's no down payment actually isn't true. And oftentimes knowing that helps you understand where a buyer is coming from as you negotiate these terms. Time of the year makes a difference. Needless to say, if you have a tax practice and most of your revenues, or a good portion of your revenues, are generated during tax season, if you sell your practice December 31st, there's a greater chance you're going to get a down payment than if you sell your practice in June, when the buyer is going to have to carry it potentially at a loss for the rest of the year. The treatment of accounts receivable also makes a difference, as I just said. So if you're willing, for instance, to allow the buyer to use your accounts receivable for a year or 2 or 3, I've seen deals as long as 5, they're much more inclined to maybe give you a down payment on the acquisition. So it's just a matter of managing cash flow and understanding the cash flow needs or cash flow investment that the buyer's going to be required to make. The second variable is the retention clause. There just aren't any fixed deals anymore. I mean, even the brokers, which we're not, who would have the buyer go to the bank and borrow much of the purchase price, can't do fixed deals anymore. Just nobody will do them. There's just too much risk involved. So the question is, what kind of retention clause are you going to be dealing with? A collection-based deal is a 5-year, 20% of collections for 5 years is a collection-based deal, and still a very common way to acquire practices. It creates, obviously upside potential for the seller as well as downside potential. It kind of just takes the risk out of the deal for the buyer in terms of retention of the clients, but also creates an opportunity to grow the value if the seller stays involved with the practice. A limited guarantee would be, say, we might set the price, fix the price after 2 years of retention adjustment. The thing to keep in mind about how long we do this is that, if most clients are going to make a decision about their new accounting firm because you've sold your firm after a test of 1 year. So they're going to come in, try it out. No, this didn't work for me. I'm not going back. If they come back the second year, they're probably going to stay long term. So most buyers are aware of that. And when you deal with a 1-year retention deal, there, of course, what's the worst thing that can happen? That the client comes in for 1 year, doesn't come back. So what do? They shake the tree really hard to make sure that that doesn't happen. And so what they tend to do is they tend to run off clients that might be kind of marginal that first year, make sure that everybody, is really committed to staying with us long term, and actually can drive the value of the practice down. So 1-year retention deals we find are actually create more risk, and a 2-year retention deal takes all of that pressure off of the buyer and actually can work out to the benefit of the seller. The third component is the profitability of the practice. And it's really the buyer's anticipated profitability, although the seller's current profitability is certainly an issue. Let me give you an example. So you're a sole proprietor, you've got a $300,000 practice, you're working out of your home, your wife answers the phone, you have no employees. And all of a sudden, you make an 80% profit margin. And then you decide your wife gets tired of answering the phone, you get tired of people coming to your house, you end up renting a space, you hire an employee to answer the phone and to help out with some of the work. You probably are working too hard already, and now your profit margin is 45%. Well, when is that practice worth more to the buyer? Obviously, it's the same practice either way. So the seller's profitability isn't necessarily an indication of the profitability of the practice. It depends on how that practice will be operated within the buyer's hands. The second issue that comes into play, of course, is the tax ramifications of the deal. So if we're going to make payments on a goodwill basis that have to be amortized over 15 years, there's a lot less cash flow available after tax for the buyer than if we have a current deduction. I'm not saying one's better than the other. I'm just saying that probably should have an impact on the multiple. So it's not unusual, for instance, to see a deal that might be 1x if it's a current deduction be adjusted to 80% or 85% if it's a goodwill deduction. And then finally, the length of the payout period. Most of the payout periods we see will run between 4 and 10 years. Still common in small practices for it to be 4 to 6, usually 5 or 6. And but needless to say, the longer the payout period, the better the cash flow, potentially the higher the multiple the buyer will be willing to make. So the thing to understand here is the cause and effect. It's like a balloon. If I squeeze on one part of the balloon, something else is going to result from that. So the cause can be the other terms, the effect can be the multiple, or vice versa. You can run it back, you can run it through the other way as well. So the market issues we already talked about. If you're in a market like New York City, it's still possible to see multiples over 1x. I mean, we oftentimes, not often, but we're seeing some deals that say 20% a year for 6 years would be a 1.2 multiple. 15, 18% over 7 years, something in excess of 1x. Hope nobody's in Paducah, Kentucky. I've been there. I love Paducah, Kentucky, but they have about 10 accounting firms in Paducah, Kentucky. And there is obviously a lot fewer buyers that are relevant to a practice located there. So you're going to see typically a discount because of where the market or where the practice is located. How much competition is for the practice? Oftentimes, again, that's driven by geography, but sometimes also by the service mix. And how motivated is the seller and how motivated is the buyer to actually do the deal? So those things can drive the value of the practice as well. Other issues that come into play: if you have a practice that has a high turnover client base, an example of that would be, say you have a lot of government work and you have to bid the work every 3 years. That can drive the value of the practice down because there's more risk associated with whether or not the business can be retained. Poor profitability can drive the practice down if you're just not charging enough to the clients, or you just don't have a high enough markup on cost. High profitability can actually be a negative if the buyer finds that it's not, when I say a negative, I don't mean a negative value, but not create a premium in valuation if the buyer perceives that they can't continue with the whatever's driving the high profitability. Say, for instance, that the seller is generating 2,200 billable hours a year. Well, nobody in their practice is going to do that. So there's going to be a high cost associated with replacing those hours, and they're not going to assume that they can sustain that high profitability. And as I already mentioned, specialty practices like litigation support practices can be an issue. Finally, these are some articles that we recommend that that we wrote for the Journal of Accountancy. There's actually about maybe 60 or 70 articles on our website that you can download from over the years. But there's 2 series of articles that we wrote on all issues associated with succession and valuation in 2013 and 2014 that are still very relevant. And then I already made reference to this how to admit new partners article. And then finally, I would also reference you to the AICPA website on the Succession Planning Resource Center, which we had a significant part in drafting the content on. There's a lot of tools on there that are of benefit. So with that, I'll send it back to Nikki. And we didn't put my email address on here, did we, Nikki?
No, it doesn't look like that. If you have any questions, if you reply to any of the emails that you got, you can reach me and I'd be happy to forward those on to Terry and he can respond to you directly. You will get an email from us in about an hour that will include links to all of the articles that Terry recommended and to those recorded webinars that you can watch, not for CPE, but just to get additional information on those topics. I just wanted to give you a quick reminder to not close your browser until after you've completed the survey. That is the second requirement in order to get your CPE credit. If you have any questions, feel free to reach out to us, and we hope you enjoyed today's webinar. Thanks so much. Have a good day.